welcome back to another Explainer. Today, we're going to totally flip how we look at AI. When we talk about artificial intelligence, we usually picture software, right? Really clever chatbots, generative models magically creating art or writing code. It feels ethereal, like it just lives up there in the cloud. But today, we're stripping all that code away. We're looking at the massive, heavy, physical infrastructure that makes all this magic actually happen in the real world. We're talking concrete, raw silicon, giant cooling pipes, and miles of heavy power lines. Let's get into it. So let's start with this absolutely staggering number, $600 billion. By 2026, the big five hyperscalers, the massive cloud providers running the backbone of the internet, Amazon, Alphabet, Microsoft, Meta, and Oracle, they're projected to spend over $600 billion. They are frantically searching for AI gold. That's a massive 36% jump from just the year before. It is a truly historic chunk of change being poured entirely into physical infrastructure. And honestly, it's reshaping the global economy right under our feet. But you really have to ask, where is all that money actually going? To grasp the sheer scale here, just look at Amazon. Amazon alone is planning $200 billion in capital expenditures over the next few years. To put that in perspective, that single tech company's budget completely dwarfs the entire publicly traded U.S. energy sector's annual investment budget. Just think about that for a second. An e-commerce and cloud giant is spending more to build server warehouses than major oil companies are spending to drill wells and refine oil. We really have to follow this money to see who's cashing these massive checks. Okay, so where does all that capital actually flow? Well, roughly 75% of this mind-boggling budget, we're talking about $450 billion, is going directly into the literal, physical plumbing of AI. And it's not just about building the massive warehouse rooms themselves. It's buying those wildly expensive, super advanced GPUs. It's the high-performance servers, the specialized cooling racks, and the incredibly complex networking gear you need to tie thousands of chips together into one giant supercomputer. That is where the real money is being made right now. Now, you might be wondering, why the frantic pace? Why spend so fast? Well, these tech giants are acting exactly like miners in a modern gold rush. Amazon CEO Andy Jassy actually hit the nail on the head. He said, as fast as we install this AI capacity, it's getting monetized. The enterprise demand out there is just ferocious. AWS is growing at 24%. So these companies are locked in this desperate, high-stakes race. They literally have to install capacity as fast as physically possible, because every single day a server isn't running, well, that's market share lost to a competitor. All this frantic spending brings up a pretty fascinating historical parallel, and it totally reframes how we should look at the AI boom. In any gold rush, the most reliable, guaranteed profits, they almost never go to the prospectors hoping to strike it rich. Nope. The real winners are the companies selling the massive hardware shovels, the pickaxes, the denim jeans to the miners. Right now, Wall Street is watching tech giants passionately battle over who's spending too much, while the companies supplying the foundational infrastructure, they just sit back and collect the profits. Take Taiwan Semiconductor, or TSMC, for example. Their dominance is just absolute. They hold an incredible 68% of the global foundry market by revenue. Now, for those unfamiliar, a foundry doesn't actually design the chips. They physically manufacture and print the incredibly complex microscopic chips designed by everyone else. TSMC builds the cutting-edge silicon for NVIDIA, AMD, Broadcom, Apple, you name it. And the beauty of their position? It doesn't even matter whose AI chip architecture ultimately wins the market, because TSMC is almost certainly the one manufacturing it. They are the ultimate, irreplaceable pick-and-shovel play. And then we have the traditional hardware giants like Dell. A few years ago, you probably only thought of Dell when you were buying an office laptop or a basic desktop tower, right? But today, their earnings reports are absolutely exploding as they supply the heavy machinery for this vast data center build-out. They just reported a record-breaking $43.8 billion in revenue for their fiscal Q1 2027. That is an 88% jump year over year. Their execution has been exceptionally strong across their entire enterprise business because they pivoted hard straight into AI infrastructure. But the absolutely crucial point to understand here is the specific driver behind Dell's massive surge, $16.1 billion. That's the revenue they recognized from AI-optimized servers in just one single quarter. Just to give you a sense of scale, that represents a 757% increase year over year. No way, right? But it's true. The demand for the specialized physical cabinets that house these hyper-hot, incredibly powerful AI chips, it's showing absolutely zero signs of slowing down. Companies are effectively lining up around the block, just waiting for the physical hardware they need to run the software of tomorrow. And we're also seeing incredible, almost unheard of profitability downstream in the memory sector. Large language models need vast amounts of rapid access memory to function. Without it, the processors just bottleneck and stall out completely. Because memory is such a critical constraint right now, companies like Micron are pulling in nearly $24 billion in quarterly revenue. And get this, it's paired with a jaw-dropping 74.4% gross margin. Tight global supply plus sky-high AI demand is pushing their free cash flow and earnings per share to absolute record highs. It really proves memory is a premium asset in the AI era. But look, this massive hardware rollout brings us to an entirely different, heavily overlooked sector. Because you simply cannot run a $600 billion data center ecosystem without an absolute ocean of electricity. AI chips run incredibly hot. They require vast amounts of continuous power just to do the computing, let alone to cool the whole facility down. Because of this, Microsoft alone is projecting its electricity demand for AI data centers to surge by over 600% by 2030. It's a logistical challenge unlike anything we've really seen in the modern era. And this unprecedented power crunch, it's exactly why utility and energy equipment companies are quietly emerging as massive winners in the AI revolution. Big tech is on a desperate, really expensive hunt for reliable, continuous baseload power, stuff that doesn't just shut off when the wind stops blowing. Google dropped nearly $5 billion acquiring Intersect Power. Meta signed a literal nuclear power agreement at Comanche Peak just to ensure their servers stay on. And companies providing the critical gas turbines and grid solutions, like GE Vernova, they're surging simply because they keep this infrastructure alive. Now, the hardware story isn't just restricted to Silicon Valley megacabs or Texas energy grids. There's this fascinating, hidden market of highly specialized AI infrastructure suppliers scattered all across Europe. While everyone is busy watching NVIDIA and the massive tech giants, these specialized European companies are quietly supplying the incredibly intricate, niche components that let these massive data centers function at a microscopic level. It's a vital piece of the supply chain that most mainstream investors are totally ignoring, yet it's generating some of the highest returns in the entire tech sector. Just look at the year-to-date growth in this European sector. It is simply phenomenal. I mean, these might not be household names to us, but companies like Sivers Semiconductors, they're up over 2,200%. Why? Because they make the tiny, hyper-specialized laser arrays that move data as light inside AI clusters. Over in France, 2CRSI is up over 400% for designing advanced immersion cooling systems. They literally dunk servers in specialized fluid to stop them from melting. The global market is heavily rewarding these hyper-specialized enablers, proving this opportunity goes way beyond American shores. Okay, but amid all of this wild enthusiasm, we really have to pause for a reality check. The bull case here is super obvious. Hyperscalers are incredibly profitable, dominant businesses, generating massive cash flow to fund this build-out. But the bear case? It points out a dangerously wide gap. This infrastructure spending is eating up roughly 94% of these companies' operating cash flows. It's forcing tech giants to issue a projected $1.5 trillion in new corporate debt. Meanwhile, direct AI software services today, they only generate about $25 billion. That means the direct revenue right now is just 4% of what's currently being spent. So if that AI monetization stalls out, or if consumer and enterprise adoption slows down even slightly, the financial write-downs would be absolutely historic. And this isn't just coming from pessimistic Wall Street analysts. The leaders inside the Big Five are acknowledging the fever pitch. Alphabet CEO Sundar Pichai openly admitted there are elements of irrationality in taking on such massive bond debt for a rapid, unproven infrastructure expansion of this scale. They're building it because they're terrified of being left behind, not necessarily because the immediate math perfectly adds up. And that brings us to the core tension of this whole explainer. I want to leave you with this final, somewhat provocative thought to chew on. As we watch hundreds of billions of dollars aggressively flow into concrete, liquid cooling systems, nuclear power grids, and raw silicon, are we looking at the solid, necessary physical foundation of our long-term technological future? Or are we just witnessing the peak of a massive debt-fueled hardware bubble that's bound to burst? Thanks for joining me on this deep dive into the physical reality of AI, and we'll see you next time.